Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Is the S&P at a Jesse Livermore level, that 5,500 magic number? We're going to talk about that. That's huge. And did Jack Bogle of Vanguard fame nightmare just come true with new day trading ETFs? And have you heard of return stacking yet? Formerly, they called that portable alpha. Well, it's the same leverage trade that blew up the system in 2008, and they're going to get a do-over, a redo. But we're assured that the problems and the flaws have been fixed, so we don't have to worry about them blowing up the system this time because they figured it out. Okie dokie, we'll just trust you. And the theme of the show, changing in duration mindset. You need to change your mind. Why? The bond move is now, not in a few weeks, not in a few months. The market does not care if you're ready. It just doesn't care. Okay? Now, like the wind, it's going to be gone soon. So you need to ride like the wind. By the way, on a side note, my sister actually went to high school with Christopher Cross. But anyway, like Buffett, not Jimmy, but Warren, you need changes in latitude, but we need changes in duration. We need changes in your mindset because the T-bill and chill trade it's going to be over literally in a couple weeks. And you need to make some massive changes to your fixed income portfolio if you're doing that asset allocation model. Now, but before I forget, Don Vandenbord, our senior portfolio manager at Revere, Don V, was on IBD Live this morning, and we're going to find out in just a few minutes how it went with Don Ho. And we're going to go to the team at Revere. But first, I want to do just a couple of articles very quickly. I'm just going to do a drive-by. All these articles are in the show notes, so you can read them yourself. But here's the thing. This article about the uncorrelated assets, right? So there's this new offering called Portable Alpha. It's these new ETFs where they have return stacking. And what that means is they're going to get you the return on the S&P 500 or the NASDAQ. There's a bunch of them. And they're going to get you that return, right? But they're using futures to do it. Well, futures, you only need a few dollars. It's like poker, you ante up. You just need a few dollars to lock in a whole futures contract. So with just 5 or 10% of the account, in an S&P futures contract, it's like you're long the whole account S&P. You got 100% correlation. But now you've got a lot of extra cash you can do other things with. And so they can stack on more sectors, trades, and leverage. So you can have 200, 300, 400% exposure using the same dollar. Now, here's what they're saying. They're saying that basically they said because you can achieve this through leverage, you can add on or stack a bet on top of that in a trend following strategy. While the math is thorny, the principle is that if you package enough uncorrelated assets, there's no sin to use leverage to juice the overall return. Okay, now, it says this burned pension endowments in 2008. In the past, the result was too much leverage in too concentrated, too few bets, and that the assets were too correlated. But by stacking uncorrelated assets in a time when stocks and bonds are inclined to move together, he expects these new breed to work fine. While sound in theory, it is not risk-free. Leverage works both ways. It's also based on a historical relationship that may not last, particularly over shorter periods. Folks, here's the thing these PhDs from Harvard and Yale are missing, okay? When it hits the fan, when it gets ugly, when you've got a liquidity crisis, all the correlations grow together. They all become positively correlated, and they all go down, albeit at different rates. They all get taken to the woodshed, except for maybe gold or maybe treasuries or just a few asset classes. So all of a sudden, at the exact same time that you need, quote, diversification for the benefits during drawdowns, it's not there. By the way, it's not there for your asset allocation 60-40 bond fund or your target allocation funds. Those all become correlated, and they all get taken to the woodshed. So, folks, the diversification, it's a lie in a market, in a bear market. It all goes down together. The diversification doesn't help. The only time you want diversification is on the way up so that one position doesn't kill you. In any event, that is in the show notes, so you can read that. Now, the other thing that I wanted to go over, the Bogle one is very interesting. It's about the single inverse and single leveraged ETFs, like a single NVIDIA or short NVIDIA. That just drives Jack Bogle crazy because he thinks you ought to own his Vanguard indexed ETF, very low fee, set it and forget it, and never sell it. And by the way, if you do sell it, you can't get back in for 90 days because Vanguard's going to punish you for ever selling their ETF. All right. One last thing. This is limiting losses with the yield curve. It says, I'm just going to go over this very quickly. It's in the show notes. Burgeoning, steepening yield curve implies economic, and what it implies in economic growth and Fed policy. Basically, it says that while the market is normally in an uptrend, the downtrends, while relatively brief periods, are usually much more significant. Okay. And they say it's equally important. Not only do you want to let the ride with the market when it's going up, it's equally important to avoid letting bear markets reverse your progress. The time spent in bear markets is minimal, but the time lost recovering your wealth can be substantial. Folks, listen, there's a great quote I want to bring up. Those who want safety will avoid risk. Those who want to be wealthy learn to manage it. So in any event, what this is also saying is that steepening trades, steepening the yield curve, typically occurs when the economy is slowing and they're anticipating rate cuts. So folks, long-term rates can go up or rates can all come down together, but short-term goes down faster than long-term. That's how it can also steepen. So either short-term rates can come down, long-term rates can come up, or they can both come down together, but with short rates coming down more. That is about to happen. Anyway, it says, by definition, Treasury bonds have positive returns in bull steepening, but the 2-year will fall more, the yield will fall more than the 10-year. That's what I just said. Now, a couple of takeaways. Gold and gold miners are the best performers during steepening yield curves by a lot. Staples also do well. Broader stocks generally come under pressure, and the difference between small and mid caps were minimal, and so was value and growth was minimal. That's what I'm trying to tell you. They all go down together, but just at different rates. The whole point of his article, though, was during steepening yield curves, you probably need to make some adjustments, take some beta in your stock portion off the table, but definitely go longer in the bond curve, which leads me to the main topic of this show. Folks, I know I have beat this to death the last 2 shows, but this is the last time, I promise, and then I'm going to let it go because your time has run out. You've missed it. Okay? Now, hi, Dan. I hope you're well. I'm sitting here listening to Ted's market wrap up, and it reminded me that I wanted to ask your opinion of bonds for a portion of my 401k with Fidelity. I'll be 71 in March. Don't know if it's a good idea to lock in rates, meaning long-term rates, with a portion of my portfolio. I'm anticipating as we move forward together, he's a new client, I'll put more money with you down the road. Would you suggest putting 20 to 25% in bonds through a bond fund? Fidelity, of course, has pitched in individual bonds, but you've taught me to be suspect. I'll get to that in a moment. I've listened to your podcast a couple weeks ago that addressed this. I agree that the bonds in the past have not been doing their part, 60-40 portfolio, and I've just been taking the 4 to 5% rate. the short-term T-bill and chill rate. Do you have any thoughts on this? Oh, yes, I do. And let me know what I should be considering. Your appreciative Jewish buddy, DK. Me, Shalom. I called DK. I called him directly to talk to them about this because it is so timely. But here is what I told him. Okay, folks, the yield curve is right now is dynamic and it's having huge systematic changes in the yield curve. You need to go long the long bonds, and look, bonds are not nearly as active as stocks where you got to constantly watch them and manage them every day. But there's few big inflection points where you got to make big changes, wholesale changes in your portfolio, and it all happens within 2 or 3 weeks. And if you miss it, bombs your uncle, you just missed out on 6, 8, 10%, literally, in capital gains. So now, so I got a ton of calls regarding bonds and idle cash and how to use that, okay? But here is the thing. The T-bill and chill trade, the buying treasury bonds or the short-term treasury money market, Fidelity defaults to that. At Schwab, you got to buy it, right? It pays like 5% or 5.1. The Fed is about to lower rates, and they've said that. They've come out, and they're going to lower rates at least 1/4 point in the next week or two, and it possibly is going to be 0.5%. I personally think it's 0.5% because they're behind the curve, and the economy is slowing very rapidly, and they know it now, and they've realized it. Okay, they're also want to help incumbents, whether it's Republican or Democrats. They just want to have the incumbents grease the wheels for the incumbents because they don't want to have someone running against them. Point being is they have made it very clear they're about to drop rates. Long-term bonds have already gone up mid to high single digits. So you've already missed maybe half the move in capital gains, not the yield. Now, with the yield, long-term rates or short-term T-bill rates paying 5%. When the Fed goes, we're dropping that by 0.5%, that short-term rate's going to go down to 4.5. Right now, that long-term bond, one of them is paying 4.6. Another one's paying investment-grade corporate only is paying 4.89. Another one's paying 4.64. But you can buy those now and lock those in. So when rates drop, now you're getting the same as the money. I'm averaging kind of approximately. You're getting the same as the short-term money market now, but you've locked it in. Here's the kicker: that just went up 6 or 7% in capital gains because prices of bonds go up when rates go down. The longer duration bonds are more sensitive to interest rates. So a 2-year bond is not going to go up hardly at all with lowering rates. A 5-year bond's going to go up some, 10-year bond's going to go up more, and a 20-year bond's going to go up a lot. But you've also locked in that yield. So on a total return, again, I'm just approximating. This is philosophical. On a total return, you're making 5% in the short-term treasuries. In another month, you're going to be making 4.5%, and by December, you may be making 4%. Okay? Early next year, you'll be making 3.75 or maybe even 3.5 by the end of next year. So now you've averaged around 4 to 4.5, not 5 anymore. 5's going away. It's the past. It's in the rearview mirror. With the long-term bonds, you've now locked in 4.5, and now when they drop rates, you'll also get a capital gain of 4, 5, 6, 7, 8, 9, even 10%, especially if they drop them by a whole percent over time. So now, if you're you cringe when I say this, asset allocator, or you're just doing a pie chart, set it and forget it. Remember, 60-40 got crushed in 2022. Everybody was piling into bonds as rates went down. They're performance chasers in 2021. I was telling you, get out of all bonds, do not have long bonds. They got crushed, worst year than ever. So now all the media came out and said, oh, the 60-40 is dead. Folks, right now is the time for the 60-40. If you're going to do that, we're more tactical. We measure what is happening while it's happening. But if you're going to do an asset allocation, you need to do a substantive shift. If you've got safe money parked, you need to switch that and do longer bonds. Now, unless you just don't care about the yield. but you'll make a lot more in your safe money if you do this. If you've got any questions, call me at 855-REAL-WEALTH or just email me, dan@revereasset.com. We don't talk about this enough. I do manage for a few clients. We've got some safe money, fixed income only funds that we do for clients that have, money with us in the stock and protection and a lot of money, but then they want to have a couple $100,000 that's just not at risk or very, very low risk, and they've got all investment. And I do that. And up until now, it's all been T-bill and chill. That's changing. We're making changes. The question is, are you? All right. In any event, and by the way, it's just some ideas. If you don't know how to do it, look, you could do individual bonds. So for idle cash, you're going to want just a little bit in the core T-bill money market. This is for your fixed income, right? For the big chunk of it, you're going to want to go long bonds, 20-year. Long bonds. That'd be 60, 70% of your portfolio. Then you might have 20 or 30 in a midterm investment grade like SPLB. That's a Spider long-term corporate bond, but that's an investment grade is IGLB. The Vanguard is BLV. But anyway, so you can get a couple different long bond ETFs very quickly while you go search for individual bonds to help you. In any event, if you got any questions on that, call me. But in another week or two, it's going to be too late. Well, it's not too late. It's just you're going to miss half the games. You've already missed a third of them. They're already happening. It is very timely. So with that, let's go to the markets and let's go to Don. Don, that was an awesome IBD live you did this morning. I watched the whole thing. I was very impressed. So why don't you kind of go over what you told them today and coupled with the market review?
Well, really, a lot of what we discussed is how we manage risk. And anybody that is familiar with our videos already knows a lot about how we handle that. But the key was the deterioration in the market today that we saw. We've been pointing out in our nightly videos that 5,500 on the S&P 500 was a key level. You mentioned that Livermore level. Well, we're now looking at the next Livermore level, Dan, which is another 100 points down. That's the 5,400 level. We're at 5,412 right now as of noon on Friday. The S&P down 1.7%, the NASDAQ 100 down 2.6%. So this morning we had the jobs report. It was a little weaker than expected. Initially we sold off, then we popped, and we actually rallied first thing after the open, but that only lasted for about 15 minutes. We rolled over, and now we're challenging the lows from 3 weeks ago, still quite a bit above that panic Monday sell-off, which was August 5th. But we take it one level at a time here. When we're above the 21-day moving average, we have a certain amount of capital we want to have at risk in the market because the market's healthy when that's happening. When you break the 21 and the 21 rolls over, we step back. When we break the 50-day, we step back. And then we look at the next three levels down, which are the 20-week or 100-day moving average. And I'm talking about the S&P 500, the 30-week or the 150-day moving average, and the 40-week or 200-day moving average. One note is that the indexes themselves, the S&P market cap weighted, looks a lot worse than the equal cap weighted. The RSP is the ETF for that. That's sitting right below the 21-day moving average, still above the 50-day moving average, and its relative strength has been rising over the last 3 weeks. And the reason for that is the heavy tech weighting of the Magnificent Seven in the S&P 500. It cuts both ways. It leads to the upside, but you'll underperform to the downside when those stocks are underperforming. And the NASDAQ 100 has been underperforming going all the way back to the July CPI report. We've been pointing that out in our nightly videos too, on a relative basis, how we just simply topped that day. So now, 25 or 50 basis point cuts, that's the focus for next week, or actually it's in 2 weeks. I think it's the 18th is the Fed meeting. it's a foregone conclusion that they're going to start cutting rates. You just went over a lot of that. But as far as how that translates to equities, like I said, one level at a time. We got stopped on a few more things today. We're down to 3/4 size positions in the portfolio in Ferrari, Eli Lilly, and CAVA, and we've reduced our S&P 500 exposure to the equivalent of 40%. That's just the rule we follow below the 50-day and above the 100-day. 0.4 beta is, or 50% in the S&P 500 is the target that we shoot for. And we'll stick with that unless we break the 20-week, the 30-week, the 40-week. And as always, we say no bear markets occur as long as we're above the 200-day moving average. This may just be seasonal weakness. It may be that we right ourselves here in the market shortly. But growth stocks have not been working. We downtraded them on the trend gauge in the nightly video this week. We downgraded our short-term moving average, and today we'll be downgrading our medium-term average, meaning we're breaking the 21-day on the indexes, we're breaking the 50-day on the indexes, and then we put our eyes on the 200-day for the absolute pull the ripcord, danger Will Robinson level. But not a whole lot of good to report out of this. We gave a level last week on the to the downside. I think it was 55.60. We broke that on Tuesday, and we're breaking the next level below that today. So
we're actually approaching the 100, aren't we? That bright red
yes,
is the
we're
50.
approaching the 100-day.
Yeah, okay. And there's a distinct line of resistance at that 5,500 that we were talking about.
Yeah, that's what you would watch now on any rally up, because the slope of that 50-day moving average is going to roll over now, and that's going to act as resistance on any attempted rally. So if we do rally up into that level and fail, same thing with the 21-day. The 21-day is going to break down through the 50-day next week. So these are all reference points for us. It's just a back away situation for us. We took a quarter size position in Tesla yesterday and got stopped out today. So that's the feedback, all the feedback we needed from the market. Got stopped on Uber and reduced some S&P exposure. So like I said, down to Lilly, Ferrari, and CAVA, and they are showing relative strength, but we've got stops in place for those quarter size positions as well. And it's time not to be a hero in the market. There's always a right time to be in the market. And as Livermore said, there's a time to go fishing. This is a time to go fishing right now. Or at the very least, stay away from anything growth related, because value stocks, value sectors is where the money has been flowing into.
Oh, man, that's classic. That's going to make the show line, Don. Is it time to go fishing, stock nerds? All right, what does the team got?
Let's start with Ted. He's going to make a comment on the TLT, but first, a couple of stocks that have been showing relative strength. Ted, let's start off with one of the three that we still own in the portfolio, CAVA.
Yep, sounds good. And so pretty much right now during pullbacks and corrections, if you aren't short, which we aren't yet, the job is to look at relative strength. And CAVA, of course, we own in the portfolio. And this is definitely one of the better acting stocks, if not one of the best acting stocks in the markets right now. We start this move into all-time highs with that highest volume ever gap up on earnings. And they did really well. Revenues grew by 35%, which is really important for a newer company, especially a newer IPO that are aiming to scale up their business, because sometimes earnings don't necessarily come in full force since they're reinvesting in new restaurants and in scaling and marketing their company. And on the earnings report, they also adjusted forward-year guidance, their EBITDA to 109 million to 114 million, up from 100 to 105. So that is always a good sign on earnings reports when management is guiding higher. And there's a whole bunch of price target upgrades as well from JP Morgan and other prominent firms. And technically, I already talked about it a little bit. Highest volume ever. We started pulling back and we found support at the lows of the highest volume ever candle or bar. that's exactly where you want to see a stock hold if it's not a gap up that immediately just pushes up forward. And so far, we're starting to U-turn here, so it's looking pretty good. If the weight of the market continues downward, this could be another one that the market takes out. But for now, pretty tight day given what the S&P and the Nasdaq are doing. So continue to stick with this one. Volume is contracting as well. RS line is pretty much near at all-time highs, so that is great as well. So that was the bullish side of the argument. I think it's important to also give what we see the bear side is. And the common bear thesis or argument now is that valuations are extremely high. Each CAVA restaurant, if you take the market cap of CAVA right now, divide by the number of restaurants, comes out to be about 44 million. I think Chipotle is in like the 15 to 20 million range. Definitely extremely high valuation, but I just want to note that an extremely high growth stock where investors are forecasting high growth and expectations in the future, that is quite normal to see high PEs and high valuations. And at the end of the day, earnings and revenues are increasing. They're coming in, they're expanding to new cities. And most importantly, the chart is telling us that the stock is healthy. So continue on, Don, you can bring up ONON. I really like these retail consumer names because their business models are more or less much easier to understand than, for example, like a tech company, semiconductors company, where it takes an electrical engineer degree to really understand the intricacies and differences between various semiconductor chips. But let's get to ONON right now. Last quarter at 300% year over year earnings growth, 27% revenues growth. And that's the second quarter in acceleration in both those figures. And if you go on a weekly chart, Don, we recently broke out of a really constructive IPO weekly base. And for those that are stock nerds, as Dan would say, and want to do some studying, this does look like a LinkedIn IPO base. You might not be able to find that anymore since LinkedIn got acquired. And it also looks like the Ollie, ticker OLLI's IPO base. And those are a couple precedents that you could use with ONON. And even though it's coming back into the base and it could become a failed breakout, it definitely is a stock or a name that is showing relative strength as it's almost trading near all-time highs or at least an all-time high weekly close. So this is another name I want to point out. On the earnings report call, the co-founder and chairman talked about how they're starting some longer-term initiatives. Like if you're familiar with Zendaya, she's a famous actress who's doing a marketing deal with ONON or On Shoes. Federer has been an early term investor, and he's one of the all-time legends in sports, and especially tennis. And then they recently opened their Paris store, which they said is the largest retail store they have in the world. And so there's definitely a huge growth opportunity here. I myself own a pair of these shoes. We've talked about this before. I think all of Team Revere owns at least one pair of these shoes. And I'm starting to see them all over the place, in the gym, even just on the sidewalk, people walking around. Even lifestyle shoes, when people go out, they have a section of shoes for that as well. So they're building out their product, they're increasing their brand awareness, and they're starting to really sign a bunch of top athletes under their umbrella as well. And then finally, Dan gave a really great summary or just breakdown of how bonds work. So I'm not really going to talk about duration and the inverse correlation between yields and bonds. I'll just simply talk about my thesis, which Dan kind of already covered. So to start, the weekly chart looks amazing. You have a bottoming cup with handle base, and we are breaking out today. The last 3 to 4 days, I've seen huge volume. This week is seeing big volume as well. And to note, that previous run up, Dom, before the cup with handle, I think it was 7 to 8 weeks up in a row, all on big volume. So that clearly showed that someone or institutions were accumulating back then. It just had to take some time for it to round out a cup. Now it's recently put in a handle, and we're looking to break out over that Livermore 100 level. Right now it's coming in a bit, but still a successful breakout for now, nevertheless. And fundamentally, or based off macroeconomic standpoint, we've seen
a whole slew of weak economic data in the last few weeks to months. The unemployment rate is over 4%, came in line this time at 4.2%. The non-farm payrolls came in softer than expected today at 142,000 versus 165,000. And then ADP yesterday came in softer as well, 99,000 versus 140,000. And the job openings the day before came in softer as well, 7.7 million versus 8.1 million. So less Americans are working now. There are less job opportunities for Americans as well. So definitely a weaker labor market and economy. And then we've also seen manufacturing and construction spending come in softer than expected this week too. And then looking at the labor market in the last year, Biden and the current administration has talked about them creating millions of jobs, but we saw the jobs revised down 818,000 the other week as well. So that further confirms the thesis that the economy is weakening. And combined with the chart now, the breakout, bonds are definitely a great play, as Don mentioned. And going with longer duration bonds like the 30-year bond or even the 10-year, you can definitely capture a bigger capital gains on that. And what Dan said, locking in those rates before they eventually come down. We have September FOMC this month, and the Fed is likely to at least cut rates by 25 basis points. And so some ETFs you can play is TLT, which we're showing here. And I guess I'm repeating myself again, like Dan mentioned, EDV and BLV are also other ETF options to play longer duration bonds.
Ted, the point you just made about capital gains, that's what has been missing from the bond equation, the yield equation. We say we don't diversify into underperforming asset classes. And looking at this relative strength line of long-term bonds going all the way back, this is a weekly chart that goes back to late 2020. This has been a losing game. You're getting your yield, you're getting your income, but your capital has been deteriorating. In fact, cut nearly in half. This was trading at 160 back in late 2020. It got all the way down to 80. But now the relative strength line is making higher lows and higher highs and a breakout of a firm base. And, there's a time to be in bonds and a time not to be. The time not to be was the prior 4 years at a minimum. And let's look at a monthly chart and see the relative strength. I mean, it's off the charts. This was, if you felt good about your diversification, you were losing your capital. And that's diversification. But yeah, time's changing now with the rapid raise in rates due to the runaway inflation. That regime's coming to an end. So good stuff, Ted. Connor, you got a couple other names that are definitely showing relative strength as well and are on our radar. The market's not cooperating, but let's take a look at some relative strength leaders.
Yeah. And just what you just mentioned about the market not cooperating that's kind of what I wanted to mention before I get into these stocks, is that sometimes the environment versus the setup, the environment can be more important. And sometimes relative strength in a name when the market isn't healthy, it's just an illusion, right? It just means that maybe the stock just hasn't been shot down yet. So that's always something in the back of our mind. And that's why we always go over the trend gauge, because that every nightly video, that's like our awareness for what the environment is. And that's factored in moving averages for key indexes along with leading stocks. And when the environment isn't good, sure, you can find relative strength names, but are they going to work? The likelihood of them working is going to be less. So that's something to always keep in the back of your mind. So with that, the first one is IoT. Super impressive today. This one's gapping up on earnings, had a 400% increase in earnings. It's gapping out of a big base into all-time highs. Volume's about 500% above average. And this is trading at high a day. In a day like today, when the market's getting smoked and this is holding an earnings gap, is really notable, especially with the volume. And one thing that I've noticed, when the market's weak and the stock gaps up on earnings, that's usually the easiest stock to get shorted, really, because a stock gapping up 11% with a weak backdrop, It's most likely going to reverse that when the tape's weak. But this is bucking the trend today and definitely going back on our watch list and is notable today. And looking back at the past price action of this stock is historically it's been very choppy. Every time it's gapped up, it's shot right back in. So maybe today with the catalyst, that could be the change in character for this one to start moving higher in an orderly fashion. Next name is GEV. This is GE Vernova. And with spotting relative strength is that the RS line is going to be like our best friend here. And any RS line that's into highs trending up the right side is notable. And you can see this one broke out recently. And now it's kind of forming a nice looking flag here right below the highs with the relative strength line confirming. And the one thing about this name is that it is a young name and it's got that great AI data center angle with the generation of power and electricity. So this one has a great theme and, reasons for it to move higher along with the positive price action. Third name is ServiceNow. I bring this one up. Don talked about it, exactly what I was thinking a little bit on IBD Live. But when you look at the other tech stocks, you look at Microsoft, you look at Google, these are breaking the 200-day. And whenever a stock breaks a 200-day, it's at severe risk for more downside. And then you look at ServiceNow, this one's trading right below highs, and you can see it had that earnings gap up. And like I mentioned with IoT, the market was somewhat shaky and it just came right back in. So the relative strength line has not been able to build off of that, but it is still building higher lows and consolidating with price. So this one's pulling back to the 21-day. And sometimes when the market starts to pull back, finding low risk entries off moving averages coupled with strength can be good tactic. And this one's right on the 21-day. So can stage a reversal there with volume. And if tech starts to bounce, that could be a pretty good idea. So that one looks good. And the weekly looks fantastic. I think the market's just holding this one down a little bit. And then the last name, I came across this name this week, and this is AMT. This is a REIT. So if you look at a lot of stocks, if you run a simple RS scan, I'm sure you'll find a lot of REITs that are popping up, and AMT is certainly one that popped up to me. And basically what they do is they specialize in developing wireless and broadcast communications infrastructures. So this has the AI angle because one thing is with the increased AI demand, they need more wireless networks, and AMT is a leader in that area. And you can see this stock has been trending really nicely up the right side. That relative strength line is showing the outperformance. And this is, some of the other AI leaders this year, NVIDIA, other names like that, those are starting to show cracks in price action. Now we might start to see those secondary leaders that have an AI angle start to perform. So definitely a name, and some of these stocks in the sector are worth taking a look at.
Yeah, you brought a nice REIT ETF, data center REIT ETF to our attention this week. What was the ticker on that?
That ticker was, one sec. The symbol was DTCR. And that's the
trades
data center.
Yeah.
And that's the data center and digital infrastructure ETF. And you can see that displays the strength in the sector as well.
Yeah, good stuff there. This is a collection of REITs that invest in data centers, and certainly the AI theme is alive and well there. Great chart, trades thin, but this is we always go to the ETF charts of different sectors to see what sectors are leading, and then that takes us to the individual names that are leading. Thanks, Connor. And Dan, that'll wrap it up from the tech side.
All right. Well, folks, listen, like I said before, that long bond trade going from short to long term is very timely. A couple things to research is BLV, that's the Vanguard long-term bond that's currently yielding 4.36. EDV is the Vanguard extended duration treasury, and they do that with strips. That's 4%. The SPLB, which is a Spider long-term corporate bond, that's 4.89. That's got all kinds of corporate bonds, including some high-yield corporate, not all investment grade. And then the investment grade IGLB, which is the iShares investment grade 10-year longer than 10-year long bond, that's 4.64. So you could mix up a few of those, go long treasuries, go long some investment grade, and move mostly out of the T-bill and chill. But those 5% rates, folks, they're going away real soon, like this month. What's your plan? Folks, listen, if you like what you heard, please tell a friend, tell a neighbor. Just tell them to go to revereasset.com. Up in the right-hand corner, there's a subscribe button, and this podcast will go directly in their inbox on Saturday morning. And our daily market insight videos, every night the market's open, we do a video telling you the midterm, short-term, and long-term strength of all the indices, and then stocks we're bird dogging and tracking, and things we're doing actually in our client portfolios and our own portfolios, because we invest right along with our clients at the same timestamp and the same price. You can also, next to it is a contact us button where it'll send me an email, and I'd be happy to talk about a stock or a complimentary portfolio review if you got a topic on the show. And you can also email me at dan@revereasset.com. You can also call us anytime at 855-REAL-WEALTH and subscribe to our YouTube channel, just Revere Asset. Just search for revereasset.com. You'll actually get this podcast before the close on Friday if you do that. Folks, have a great and safe weekend, and we'll talk to you next week on Your Money.
Because it's not about how much you make in the markets, it's about how much you can keep.